is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Welcome back to another episode of DeFi Decoded. My name is Andrew Young, and I'm unfortunately not here with my co-host Alex Tapscott, who is taking the week off. And he's no better for it because we have an incredible guest today. His name is Samir Kerbage. He is the Chief Investment Officer of Hashdex. Hashdex is one of the sort of pioneers in crypto asset management. And Samir has been the CIO since 2018, overseeing the firm's global investment strategies, product development, and research. And he's been with it since inception, leading their crypto asset management arm on the ETF side, ETPs, and other investment vehicles. He's been involved in the digital asset space since 2016 and has over 15 years of experience in financial market infrastructure and quantitative trading. So really, really excited to be here today with you, Samir, and welcome to the show.
Hi, Andrew. Thank you for having me.
Yeah, so before we start, we would love to just kind of like understand how you got into the crypto space, coming from this more traditional financial background, and just kind of curious to hear about your journey.
Yeah, so I'm a computer engineer, and like you mentioned, I started my career in the hedge fund industry. Then I migrated to market infrastructure. So I started to create a new stock exchange. It was a very interesting project to create a competitor to the Brazil's B3. Like they have a monopoly on the stock exchange side in Brazil. And I worked for this project for a while. And while I was at that project, I started to hear back in 2015, 16. Like all the big financial markets and the discussions on the different boards was that Bitcoin is for anarchists, but blockchain is something that's going to transform financial markets. And I started to get involved in that and try to understand what that was about and how we could use that to create a competitive advantage in the project that I was working on. And that's where I started exploring with permissioned blockchains. And then I came to, understand about Ethereum and open smart contract platforms. And I saw DeFi. I saw that, basically could replace the whole market infrastructure that was building with few lines of code. This traditional infrastructure would take billions of dollars in capital, very people and capital intensive, and you could replace that for software. That was mind-blowing to me. I was always very interested in the intersection between technology and financial markets, and I saw on crypto just this perfect intersection. So back in 2016, when I finally realized this clicked on my mind, and then I started to invest in crypto, starting to get more involved in the space, and then decided in 2018 to come full-time to build this industry.
That's awesome. Yeah, it's interesting. There's a lot of your background is obviously incredibly unique, but in a lot of ways, a lot of the people who sort of got into crypto back then had similar sort of story. Like for me, for example, I was working on the trading desk and kind of similar sort of realization of realizing that you could use kind of blockchains to make these things way more efficient. But so yeah, I would love to hear kind of the Hashdex story as well, because you guys have obviously been pioneers in this space, and just really curious to hear kind of like what was the origin story and how is it kind of involved into the company that it is today.
So Hashdex was founded based on the opportunity we saw, especially back in 2017, when a lot of different projects that started to flourish around crypto, not just altcoins in the sense that they're trying to do different versions of Bitcoin, but really, projects, decentralized organizations, and different blockchains and all the scalability solutions, DeFi. There's a whole ecosystem that was being forged back in 2017, and we saw this as a new asset class. When we look ahead, so we thought back then, when we look ahead 10 years from now, we're going to see crypto as a new asset class. And there's got to be way for you to invest this in your traditional rails. For traditional investors, institutional investors to get involvement in this without having to go to the nuances of, holding your own crypto wallet, doing a cold storage, and all those types of technical aspects. That so we saw this opportunity, and we started a crypto-focused regulated asset manager to offer investment solutions to traditional investors. Okay, so, and then the first challenge that we had, of course, there's a lot of technical challenges around the market infrastructure, right? Custody, trading, etc. But the first one was the investment strategy. How we would design this investment strategy, and we saw that there was no benchmark for the space. There was no way, if you're doing an active fund, to measure your performance against the market, like you would do for an S&P 500 or a Nasdaq 100. So we saw this as an opportunity. We decided to create a benchmark for the space. So we designed our index. Back in 2018, we created the first fund that was a passive fund tracking that index. And over time, we've built a partnership with Nasdaq, and we transitioned that index to Nasdaq. And this is now the Nasdaq Crypto Index. So we have a very robust methodology that's designed for institutional investors to replicate and get exposure to this space as a new asset class. And now with the governance of Nasdaq, which is a very traditional player in the TradFi space, they have a lot of experience and reputation on building on the tech industry and building indices for technology. So this was back in 2021, and we launched the world's first crypto index ETF tracking the Nasdaq Crypto Index. There was a fund back in Brazil. This was one of the more successful fund launches in the history of the ETF market in Brazil. And right now it's the third largest ETF in the country. It's the second most popular ETF, traded in Brazil. And we started to expand this to other regions. So we have now presence in almost 10 countries. The largest crypto index ETF in the world, and the second largest. So we have the largest one in Brazil, the second largest in Europe. And we recently launched that version of an index in the US. So it's the Hashdex Nasdaq Crypto Index US ETF, tracking a US version of that index, which is designed to be evolutive and to evolve as the regulatory environment evolves in the US. So that's in a nutshell how we build and why we build Hashdex. We started the company also to build in the US, but we soon realized that the regulatory environment was not there for a regulated asset manager. So we decided to expand internationally. So this is a little bit about our story and how we came to this place.
Yeah, what's interesting too about Hashdex too is I totally agree. It's obviously a fully new alternative asset class, but what's interesting is that it's an asset class where the failure rate of different projects is also incredibly high, right? There's if you look at the old thing is if you look at the top 100 list or top 10 list in 2013, and then you look at it today and most of them are gone, and kind of the same thing with 2017, or maybe not, they maybe haven't gone to zero, but a lot of them have sort of fallen out. So I'm kind of curious, how, because I was looking at the index. And it looks like it's roughly 77% Bitcoin, 10% Ethereum, and sort of 6% XRP, and then, kind of Solana and a couple others. But I'm really curious to hear kind of how has the index sort of evolved over time? Has it gone, because obviously in 2017, there was far less investable assets than there are sort of today.
Yes.
And I'm just really kind of curious, over the 9 years, how, was it kind of 99% Bitcoin when it started and then it's sort of fallen, or what are the trends and stuff like that?
Yeah. So, and this is part of any emerging technology. Okay. So you have this, transition, you have this shift over time between assets. Some assets go to zero. There's a lot of experimentation happening. It's too soon to call the winners. This is not different from how the internet was back in the 90s. So if you look at the Nasdaq 100, from the top 10 holdings of the Nasdaq 100 in 1999, only Microsoft has retained its position on the top 10. So this is normal for for the tech space. It's normal to, if you look at in 5 years, 10 years horizon, there's a shift around this. And this is very normal. In crypto, this is way faster because this ecosystem is evolving in an exponential rate, way faster than the internet evolved in the 90s. But so it's very natural. So that's why we have designed a methodology that is evolutive and dynamic. Okay, so the idea is to replicate and reflect the market, however the market is. So the index started with 5 assets and 90% concentration on Bitcoin. And it evolved over time, over some bull markets, it went up to 13, 14 assets, and like a 60% weight on Bitcoin. Now it has 9 assets and 70% weight on Bitcoin. So it's designed to reflect whatever the market is. If the market expands, as we believe it will, as a new asset class, this index can have like 20, 50, 100 assets. There's no limit to the number of assets this index can have. On the other side, if the market contracts and the only asset out there is Bitcoin, the index is going to be highly tilted towards Bitcoin. So it's really designed as a benchmark to represent the space, like for passive investment and also for benchmarking. So once we start to design, for instance, active strategies, we use that index as a benchmark, so as a starting ground for building this strategy. And the big differentiation about this index is the eligibility rules. So how can we define the universe that's actually investable by institutional investors? So this is the rule that Nasdaq applies very diligently. It's the same governance committee that runs the Nasdaq 100 that's looking into the crypto as an asset class, looking at which assets can be invested by institutional investors and then maintaining this index.
Yeah, I think that's like one of the most interesting aspects of this as well, is just is like these are all obviously assets that are investable, but like from a crypto native person's perspective, they would be sort of slightly maybe confused by some of the components. Like Litecoin is included in that top 9, whereas most crypto native people wouldn't even, they stopped investing in Litecoin a long time ago. I think one of the big things that's also pretty, if you would ask me 5 years ago, kind of like when we first started the DeFi Decoded podcast, I would have thought that, there would be more than just Uniswap in there at like a 15 basis point weight. And most people, I think, would have thought that Bitcoin would be below 60% contribution instead of, it almost sounds like the midpoint of its range at 77%. So I guess I'm just kind of curious, like, what have been the surprising developments from your perspective of sort of, obviously you're in the weeds tracking kind of institutionally investable assets like crypto. Like what's been like the most surprising sort of element of this index over time?
Yeah, so we also expected that Bitcoin's weight would go down over time, and new assets, especially new decentralized apps, would be eligible for the index and included in the index. But what we saw in the last few years, especially after 2021, is 2 things. First, a contraction in liquidity. So interest rates went up. That is very negative for all the risk assets. It's even more damage, causes even more damage for such an emerging asset class like crypto that depends on venture capital, depends on a lot of money into R&D, into experimenting new things. Also, like if you look back at 2020, 21, when we had this expectation of like a DeFi boom, a DeFi summer, etc., the infrastructure was not there. So if you really tried to use crypto back then, it was very slow, very expensive, and super complex to use. So over time, just like the internet in the 90s, the internet in the 90s was very expensive, was slow, it was very hard to use. Over time, there was a big investment in infrastructure and usability, and now the internet is what we can live without it right now. The same thing is happening with crypto. We're seeing infrastructure evolving, so a lot of like scalability solutions, different setups and architectures being tested out, and this is a critical step for like growth of this ecosystem. The other big headwind this industry was facing was lack of regulatory clarity. And in fact, really like a regulatory crackdown was coming, especially from the US. So this is over now. We have a new administration looking at this in a different stance. So we think that over time, this is going to change. This is already changing. If you look at Stablecoins, Stablecoins is the first killer app of crypto. It's the first use case of tokenization. And after we start using stablecoins on a day-to-day basis, will be way more natural to start using tokenized assets and then using DeFi solutions to manage, to transact with those assets. And then like this ecosystem will grow. So I think we're in a good direction. So few years of headwind that we haven't seen much applications. On the other side, if you look at Bitcoin, the case for Bitcoin is only getting stronger year over year. So after 2021, what we saw, like the Russia's invasion of Ukraine, very positive for store of value thesis. We had the banking crisis in the US in the other year. We had the Bitcoin ETFs. And now we're seeing the U.S. government adopting this as a store of value, right? So putting out that this is a new store of value. So the case for Bitcoin as an emerging store of value is only getting stronger, although like the liquidity conditions are not good. So we saw this confluence of two factors. That's why the weight of Bitcoin is still high when you look on a market cap basis. Is like the last few years have been great for Bitcoin. Adoption has been growing exponentially. Adoption and institutional adoption growing exponentially. On the meanwhile, like all the other applications of crypto, especially on the smart contract side, most of the innovations are around the infrastructure. It's really how to make this scale. And once we have the scalability solution out there, we have a regulatory clarity, we're set for the industry to go over the next few years.
Yeah, what's interesting too, as I look at the performance, I can't help but think that your index has probably outperformed 90% plus of the active managers, just given the fact that you guys are obviously, more overweight Bitcoin than I would say the average active manager in crypto. Most active managers don't hold like a 60-70% plus Bitcoin position.
That's the reality for like most of the markets. It's very hard to beat the market. And if you look at the S&P 500 and Nasdaq 100, it's really, really hard to find managers that consistently beat the index. And that's one of the arguments for passive investing. And this is no different from crypto.
Yeah, no, totally. It's exactly the S&P 500 was exactly what I was going to say. Like it's interesting too, because I think the index would have, in a lot of ways, there's all this hype around NFTs. I don't think you guys probably never really had a direct NFT proxy in there because there's never an NFT asset that got big enough. I guess indirectly through Ethereum. Maybe Ethereum's exposure is a bit bigger, and same thing with the meme coin craze. Solana's weight maybe went up. Solana's weight maybe went up a little bit, but besides that, there's no.
The meme coin frenzy was very positive for Solana, and the index captured that indirectly. But the index doesn't invest in meme coins, and like those eligibility rules make sure that assets that are more mature can make it to the index, and that's why we need some time, we need maturity, we need growth on this ecosystem to be eligible.
Yeah, for sure. I do want to talk. So before we kind of get into the whole Treasury co-mania, because I think that's something that a lot of people are talking about right now, I do want to. You brought up this really great point about how stablecoins are like the killer use case for crypto. Like some people are calling them kind of like the ChatGPT moment or whatever you want to call it for crypto. And I was just kind of curious to hear what you think. Like there's been a lot in the last kind of week or two. A lot of people are starting to bring up kind of Ethereum as being like the big winner of this movement. You have people like Tom Lee going on CNBC saying, if you're bullish stablecoins, buy Ethereum. I'm just kind of curious, like, what do you think about, stablecoins and I guess RWAs to a certain extent? And do you see that as kind of being like, I guess, the potential salvation for Ethereum? Because obviously Ethereum's been sort of underperforming. I would guess that it's probably kind of gone down as a weight from its high in your index. I just kind of, how do you think about those sort of two things?
So first of all, stablecoins I agree, is a killer app, and the reason for it is if you look at the payment rails that we use on a day-to-day basis, this technology, this was invented 70 years ago with the credit cards. When you wire money, when you send money, that's the same technology that was used in the 19th century. That hasn't changed much. So instead of using, cables, we're now using the internet, but that's still like the same process. It's very manual, very, very like a legacy and analog and relying on people, and people make mistakes and reconciliation and all those types of things. Stablecoin offers a new rails for payment. And we've been seeing like a huge growth of stablecoins in emerging markets. So if you look in Asia, if you look in South America, Africa, there's an explosive growth of stablecoins. And we haven't seen much adoption in the mature markets in Europe and the US, and that's basically because of lack of regulatory clarity. So now, with the Stablecoin Act, with the Genius Act being approved and going into effect, what we expect to see is that most of the banks will start offering stablecoins and will start offering payments in stablecoins. The big tech companies will also get involved into this space. This is going to create competition, and competition is great for innovation, and it's great for improving the user experience, which is the big blocker for crypto. So once we start to have like all those big tech companies, the big banks entering the space and offering stablecoin payments, stablecoin rails for payments, instant payments with no cost 24/7, then we're going to see explosive, wave of innovation. This is definitely very positive for smart contract platforms overall. Ethereum has like a very strong leadership position in a network effect, so it tends to benefit from this wave significantly. Like we are passive investments. We believe in the index approach. We believe it's too early to call the shots on the winner. So maybe in 5 years from now, 10 years from now, will not be Ethereum, will be another platform. But right now, we're seeing the Ethereum as a clear leader in this space, because most of the innovation, most of the experiments are happening on the Ethereum network. So I think it's very positive for all the smart contract platforms. For Ethereum specifically, it's great. And once we start to transact into stablecoins, if you think about like RWA and tokenizing real world assets, the big challenge is like, why are you tokenizing it? Like, who's going to use it? Most of the investors they're not on chain. Like, most of the capital is not on chain. So once you start to have capital on chain, once we start to transact into stablecoin, and it's just going to be way easier to do everything with stablecoins, most of our balance will be on chain. And then like the next natural demand you will have, like if you start to accumulate money in stablecoins, is money market funds. So you're going to tokenize money market funds. After you have enough of a reserve, you're going to start looking for investments. Then you're going to start to look for equities, alternative investments, and all those types of things. So that's why I believe that crypto stablecoins is a killer app for crypto, because that's the initial application that's going to get onboarded millions of users. And after those users are onboarded, they have an app that they're familiar with, that have their bank account and their cash. They're going to this is going to be just way easier to adopt tokenized assets. And once we have tokenized assets and cash, we can start transact, and we can create this, what I like to call this internet financial system, which is basically DeFi, right? So we have all the assets on chain, the internet of assets, and then we have a financial system running on the internet 24/7, fully digital, with no intermediary. So that's the vision I believe in.
That's really interesting. I've actually never heard anyone say that on our podcast. The fact that the stable coins themselves is the catalyst for the sort of like RWA explosion, because as you bring on the more stable coins that are on chain, that is effectively the distribution mechanism for RWAs to then come to come on chain as well. Exactly. Because the money's on chain.
When we go from 200 billion in stable coins to $2 trillion in stable coins, that money is going to look for investment, and they're not going to wire back the money to their traditional broker dealer. They're going to use tokenized assets.
Yeah, that's really interesting. So what do you, looking at the market today, I think like one of the most interesting sort of aspects of this bull market cycle we've had is that there's been a huge divergence where, besides kind of Bitcoin and a couple pockets, of outperformance, like the meme coin bubble, which led to Solana doing pretty well, for the most part, the on-chain economy has suffered quite a bit. And meanwhile, the crypto equities have done quite well. Circle's been one of the most successful IPOs. Coinbase is almost back to all-time highs. And then, of course, we have kind of this MicroStrategy, Treasury, co-mania, whatever you want to call it, where all these companies right now, I think I just saw another one today where like a $38 million market cap company announced a $400 million raise, which seems kind of crazy. But yeah, so just kind of curious, like, I guess sort of two questions. One is, what do you think is driving this divergence in performance between kind of the on-chain economy and the crypto equities? And then more specifically on like the Treasury codes, just kind of want to hear your take on sort of whether that's actually sustainable or if that's just kind of a weird thing that's kind of coming out right now because we don't have ETFs on everything or something like that.
Okay, let's start with the easy one. So why this divergence? And we've been seeing Bitcoin, like the demand for Bitcoin grow exponentially. And like I said, we're in a moment in which most of the investment and most of the interesting things are happening around scalability solutions, not much on the application side. And one of the challenges that we have for applications is that we really need to see assets on chain. So once we start to see assets on chain, then we can talk about, all those tasks and all those great projects that have been built on chain that there are right now basically transacting meme coins. The way I think about meme coins is basically they're stress testing the system. Okay, so we are rewarding traders, to go there and speculate and do all those transactions. They're stress testing DeFi. They're testing the smart contract platforms and the robustness of that platform, so that like we're in a mature enough phase for when tokenized assets, when real world assets come, that infrastructure is ready. So I think it serves its purpose. I wouldn't invest in stablecoins. I don't think there is an investment case for it, but I think there is a function for this, because without the meme coins, we wouldn't have like how to test DeFi. How can I test, all those different protocols if there's no assets? So you basically need those, you need that type of speculation in order to have assets and test the pipes. So the pipes are being tested. That's great news. And the pipes are working. They're working very reliably. So once we start to see assets on chain, there's going to be explosion of applications. And that's why we're so bullish and eager for getting this Genius Act effective, because this is going to drive exponential growth in stablecoins. And this is the first step towards tokenization. Once we have assets, then we can have a financial system on chain. Then a lot of great things will happen. So I think that's the easy part. The second one is around those like corporate treasuries, right? So I think that Bitcoin is going to eventually become the opportunity cost, the hurdle rate, right? So if Bitcoin becomes a good store of value for our society, this is going to become the opportunity cost for all the companies, and all the companies will have to adopt like the treasury strategy around holding Bitcoin. I don't think we're quite there yet. We're not in a moment in which, like, except for a few visionaries like Michael Saylor, we don't think that we're in this moment right now that Bitcoin it's already like a mainstream consolidated store of value. It's still growing, it's still emerging as a good store of value. So although we think that in the future all the companies will have Bitcoin in the balance sheet, on the short term, I'm feeling this just like kind of like a mania, like we saw in 2017, when all of a sudden the companies realized that they can do ICOs and they can raise money very easily on chain, because there was a big excitement around what smart contract platforms could do. So anyone could raise money just doing an ICO. I think now the same thing is happening there. Everyone saw that they can raise money on the public markets if they offer a crypto treasury strategy. And this has been fueling some kind of bubble. So I think there is fundament to that. We're going to see this over the next few years, but I think it's too early. There's too much excitement and not much substance right now. So yeah, that's my feeling in general around this. This is fueled by two components. Basically, you have the institutional investors. Some institutional investors cannot have access to crypto directly. So they cannot trade Bitcoin. They cannot trade Bitcoin ETFs. So there are a lot of different investors. I've seen a lot of those types of investors in Europe, for instance, that they can't get exposure to Bitcoin ETFs or ETPs or crypto directly. So they use the proxies. They use MicroStrategy, now Strategy. They use Coinbase, and now they're using those treasury companies. You have the hedge funds that, as long as your asset, your company has a lot of liquidity and a volatility that's higher than Bitcoin, they can hedge this and make a lot of money. And you have the retail investors that are just following those big influencers like Michael Saylor. So you have those three components to create a very liquid market, because there's institutional demand, there's hedge funds trading, and there's retail demand. So that's what we're seeing right now in the public markets.
Yeah, that's really insightful. I mean, it's interesting because you would think that the demand for a treasury company would go down quite a bit once you could just access an ETF, because you can buy $1 of Bitcoin with $1 instead of buying 50 cents of Bitcoin with $1. But if anything, it seems to have spurred on like a speculative mania and in these types of companies, which is very, very surprising.
And again, the innovation that I see here is, if you look at those, especially MicroStrategy, and this is reflecting in all those companies, and I think this is going to be a standard in 15 years from now, 20 years from now. I just think it's too early right now, but they're measuring their wealth and their growth in terms of Bitcoin. They're looking to accumulate Bitcoin per share instead of accumulating dollars. Instead of generating profit and accumulating dollars per share, they start to measure the progress, their wealth, in Bitcoin per share. So when you invest in a Bitcoin treasury company like Strategy, you're not just getting a proxy exposure to Bitcoin. You're not just getting a Bitcoin ETF. You're getting a Bitcoin ETF with this promise that they're going to increase the Bitcoin per share over time. And this is a very compelling promise if they're able to deliver on that. So I think that's like, on the fair side, I think that's the case for investing in a Bitcoin treasury company. Of course, if they have a proper strategy, if they have a proper business behind that can generate revenues, they will be transformed into Bitcoin.
Yeah, for sure. I mean, I guess the big question there obviously is that, like, typically the valuations are, you're paying a multiple on instead of buying $1 Bitcoin, you're buying 50 cents of Bitcoin with $1. I guess exactly. In the hopes that, they can get it to like $1.50 or whatever. And, I would have thought people would just buy, something like your product, where you get a 1-to-1, you get the exposure, and then you can go from there. But so I do want to get into your predictions, but before I do, how are you guys at Hashdex sort of thinking about the market? Like, what's on your sort of roadmap for products and things that you guys are building out?
So what we're seeing right now is a great moment in the US, in which finally there's regulatory clarity coming for multiple aspects of the crypto industry. And like I said, this is going to be very good for innovation. You have the largest capital market on the planet, the most innovative country in the world that will be open to exploring crypto, and companies will build back in the US. This is going to create a huge wave of growth, of innovation, and we're very bullish about this on the market side. And when we look at on the product side, we're also seeing the SEC working towards giving more clarity for asset managers to issue crypto products, to have crypto funds, crypto ETPs, and this is going to be great for the industry overall. So we're very bullish about this. We have started this fund in the US this year because we think that finally the regulatory clarity is here, and hopefully we're going to see an environment in which you can offer a full-blown index with more assets and more diversification to US investors. So I think that's the most interesting thing that's happening right now around, I would say, on the business side, on the regulatory side.
And then just obviously we just hit the halfway point of 2025. So really curious to hear like your predictions, I guess, for the next 6 months. What are we'll start with the next 6 months, and then before we get into your sort of longer term predictions. I mean, you sort of hinted at them with the 10xing of stablecoin size, but I guess what over the next 6 to 12 months, what are the big things you're looking at that you think are sort of under discussed, or maybe just people aren't sort of you think are going to be kind of surprising, I guess?
Yeah, I think that it's probably not going to be a surprise, but I think stablecoins are going to grow way faster than we anticipate. Once we start to see the banks and the big techs getting involvement into the space, launching their own projects, I think they're going to start even this year if things move along. So very bullish about this. I think people don't realize the impact that this will have into smart contract platforms. so into Ethereum, Solana, and other alternatives. And if that happens, we're going to like be set up for a explosion on a possibly an out season in which those assets are going to outperform Bitcoin by a lot. So I think this is something definitely in our scenario. If that happens, then I think the whole conversation will migrate from Bitcoin and Bitcoin only exposure, especially if you look on the professional side for advisors and institutional investors, which right now are mostly looking into Bitcoin. The conversation will shift towards the asset class. And that's when the case for the index will be very strong. So we are strong believers of an index approach. We're strong believers that this industry is way bigger than just Bitcoin. But, professional investors, they need to see this happening. And I think they're going to see this in the coming year or so, like the next 6 months to 1 year. We're going to see like a very interesting space for smart contract platforms because of stablecoins. So I think that's my big expectation on the short term. There's a lot of like policy, agenda. There's a strong policy agenda coming from Washington, D.C. They're working on announcements. So we expect to see more announcements in terms of how they're going to deal with the crypto strategic reserve, how they're going to increase the Bitcoin reserve over time. This can be also very positive for Bitcoin. So yeah, like we couldn't be more optimistic about like the next 6 months to 1 year. But I would say it's way easier to think about how this ecosystem is going to look in 10 years from now than predicting what's going to happen in the next 6 months.
Yeah, that's interesting. So that's actually very, very interesting because we've asked our guests for the last 12 months, what's going to spur on this altcoin revival? Because it's in a lot of ways, right? Like if it's an interesting market because people who aren't in the industry full time, who just have like maybe a little bit of crypto exposure, I would guess have done quite well on a relative basis because they would have just bought kind of like a Bitcoin, probably bought kind of similar weights to your index. Whereas the people who are in the industry full time, they tend to be way underweight Bitcoin relative to your index. And again, that's obviously not done very well over the last like 2 years. So that's very interesting. You're essentially saying stablecoins is the catalyst for alt season. I guess the counterpoint to that is, you seem pretty confident that it's going to be, those stablecoins are going to be issued on public blockchains. I guess the sort of maybe the bear case would be that something like JP Morgan, would launch it on maybe like their own permission chain or something like that. And I guess like, how do you sort of reconcile that bear case? Is that something you see as like a true risk, or is it you just don't see that as overly likely?
So I think this is certainly going to be tried, and there's a big discussion here, bigger discussion than like stablecoins, is how money is going to look like in the 21st century, right? So we're going away from paper money, right? So we're not using cash anymore, like paper cash anymore. We have to go digital. And how money is going to look like in this digital reality. There's different experiments being tested out in what they like to call the CBDCs, right? The central bank digital currencies. You have the Chinese model that's more centralized. So we have the Chinese central bank issuing those retail stable coins. You have a model like in Brazil. Brazil is testing a very interesting model that's more distributed. So what they're using is a permissioned ledger. Something very similar to what I've tried back in 2016. They're using a permissioned ledger to issue like basically stable coins, but on a permissioned blockchain. The banks will issue it, not the central bank. So we have a distributed system. And the US is in a path to try out a decentralized system. In the decentralized system, you favor competition. Decentralized system means like you give clarity for stablecoins, and now like if you follow the rules, if you register, you can issue stablecoins. So we see a lot of companies testing out different solutions. This is great for innovation, and there's no match for an open platform. It's like competing, like getting the internet and competing that with your own closed network, your intranet. Like there's no way to compete that. So I think it will have its use case, like some closed blockchains, like whatever, like JP Morgan is trying as a permission blockchain. There's a use case for that, but there's a use case only for those few set of clients. If you really want massive scale, you need to go to the internet. You need to be open. And so I think competition is going to sort this out. And there's no way to match an open permissionless system like the internet, like the open blockchains.
Got it. Okay, so that makes complete sense. Essentially, you're saying there's huge demand for stablecoins, and the majority of those stablecoins, just due to the open nature and like the global distribution of public blockchains, those are going to be issued on public blockchains like Ethereum, Solana. I believe stablecoins right now are like 30 or 40% of all gas fees on Ethereum already. And so if we like 10x the size of stablecoins, that's essentially, you know, a 3 or 4x on Ethereum's transaction fees, as well as obviously huge growth. And
Exactly.
What I love about stablecoins is it's a far more, I think it benefits society a lot more, and it's also a more sustainable form of revenue for smart contract chains like Ethereum and Solana. I guess one other sort of side question. I mean, you guys are obviously pretty agnostic to this because you effectively own both. But I'm just kind of curious if you had a viewpoint on Ethereum's sort of approach to scaling, where essentially it's almost more of like a B2B approach where people can start their own layer 2s and then they get to control their own distribution. And we're starting to see tons and tons of different layer 2s come out. Robinhood just announced their own, I think literally last week. Whereas versus like the more sort of one computer global approach that Solana has been taking. Just kind of curious if whether from Hashdex or just personally, if you have kind of a view on what approach you think is going to work long term, or is there kind of space for both?
Yeah, I think there is space for both. And just like if you look at the internet right now, there are multiple protocols that are running the internet. It's not just the HTTP. It's not just the email SMTP protocol. There's a bunch of different protocols. And you have, for different use cases, it's better to use different protocols. So the protocol that we're using now to record this podcast is not the same that we use like to navigate on the internet on our cell phones. It's not the same that people use to listen to this podcast. So the same thing, it's probably going to happen with crypto as well. You have like a general purpose blockchain like Ethereum that can basically serve to anything, and it's very open, and anyone can create their layer 2 solutions. You have like blockchains like Solana that are optimized for high throughput, low latency transaction. Maybe some transactions that are really dependent on latency, they're going to run on Solana. And transactions that really depend on reliability, availability, and trust, they're going to run on Ethereum. And that's fine. And there's going to be bridges around it. And then you can navigate across this. This approach of Ethereum to build layer 2s is also very favorable to integrating TradFi and integrating governments. So, for instance, the Brazilian central bank is working on this new CBDC project running on-chain, on blockchain. It's EVM compatible. And what they're running can be compatible with building a layer 2. So you create this whole Brazilian financial system being tokenized into this permission blockchain. And once this is mature enough, you can create bridges to the open blockchain on Ethereum. You can basically create a layer 2 on the Brazil economy. And then you can have a layer 2 for the Euro region. You can have a layer 2 for the Fed. So that's a way more scalable, more open architecture. So I like both, and I think there's going to be space for both. I personally, I think that Ethereum is way, the addressable market for Ethereum is way bigger than the addressable market for a low latency, more centralized network. But I think both are going to thrive.
Yeah, that makes sense. I do want to get one or two more last questions. I know you have to go soon, but just really quick, how do you think about valuing crypto assets, particularly maybe not Bitcoin? I think everyone kind of accepts Bitcoin as a form of a store of value and money. The big question right now is on smart contract chains like Ethereum and Solana, both of which Well, Ethereum was generating more fees than I believe it was sort of issuing, but that's no longer the case. And Solana is still quite negative. Do you buy the argument that Ethereum and Solana should be valued kind of like money as well, similar to Bitcoin? Or do you think these are more kind of hybrid assets or more like stock-like assets long-term that you can kind of value with a DCF?
Yeah, I would see them more as digital commodities. And Bitcoin is a digital commodity as well, but it's more like a gold in which you can really, you don't have much control over the supply, and the big variable is the demand, right? So if demand increases in our society, we can produce more Bitcoin, and this is going to have a significant impact on the prices. If you look at smart contract platforms, that's kind of the same, but the supply curve is also dynamic. And that's a big, question. Like the more demand you have, maybe you can get into deflationary moments, or you can get in inflationary moments. So it's more dynamic. So it's harder to price it. But still, the big variable for all of this, and we can think about all the different metrics for valuation. They will all end up into what is going to be the future demand for this. Is there going to be application, and what is the size of this application? This is a big variable for any valuation framework that you try to come up with. And this is like for any early stage, like if you look at startups, for instance, that's also the big question. How big is the market, and how much we think that this company is going to capture from that market? So if you look at the addressable market for smart contract platforms, what can be run on chain? The whole economy can be on chain. So we're talking about hundreds of trillions of dollars in addressable market. And if you have a network securing that economy, securing hundreds of trillions of dollars, that network has to have a value that's equivalent to that. Otherwise, you create incentives for defrauding the network. So that's why, it really depends on the addressable market. The addressable market is huge. And the big question is who are going to be the winners? Is there going to be a winner take all? So it's either going to be Ethereum or Solana or other chain that's going to capture all the flows, or we're going to have like a multi-chain paradigm in which there's going to be space for multiple blockchains. I still think that I still believe on the multi-chain paradigm. So I think it's going to be multiple blockchains, because this is like this space, the addressable market for this is hundreds of trillions of dollars in the next 10 to 20 years.
That's amazing. Okay, one final question. Besides stablecoins, what do you think will be kind of the next, and RWAs, what do you think we'll give it a 5 to 10 year time frame. So it doesn't have to be in the next year. What's kind of the next big killer application in crypto?
So once we have stablecoins and we have real world assets, you have your balance on chain and your investments on chain, then you're going to start looking for collateral management, for exchanging those assets 24/7. So all those DeFi applications, decentralized exchanges, lending protocols, when there is actual real assets and real people using, they're going to see explosive growth. So I think they're going to grow along with the stablecoin growth and the like real world assets growth. So I'm very positive. I'm very bullish about DeFi. And again, I think this structure is well tested. It's stress tested enough with meme coins and all the things we saw over the last few years. Like DeFi is now in a mature phase that's ready to take real world applications. So I think it's going to grow along with stable coins and tokenized assets. So I'm very positive, very bullish about the applications that will run this internet financial system, and on the smart contract platforms that will allow this economy to exist.
Awesome. Well, that's a great prediction, and we're DeFi decoded, so we'd like to see a resurgence in DeFi. But yes, thank you so much, Samir. This has been a really, really insightful, hour-long talk. We covered a lot, and I think speaking as someone who works in crypto day in, day out, I'm certainly a lot more bullish on the crypto space after talking to you. So it's much needed sort of shot in the arm for anyone who's in the space full time. So I appreciate it a lot, and We recommend our audience to go check out hashdex.com and check out their the Nasdaq Crypto Index, as well as I believe they also have an ETF as well. So lots of really cool products that you guys have sort of pioneered, and really look forward to having you back on the show again soon.
Thank you, Andrew. Really enjoyed that conversation.
Thanks, Samir.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.